Okay, so welcome back. And let's talk a little bit more now about the indirect methods by which bad debt can be dealt with. And like I said, the indirect methods are sort of anticipatory. They're done at the end of the year. You're looking forward. You're looking at your historical trends, and then you're kind of looking forward, anticipating what kind of bad debt you might encounter, who might go bad, maybe not who might go bad, but how much might go bad based on historical analysis in the upcoming period of the people whom you've extended credit to in this period. I know, it sounds a lot more complicated than it really is. So, like I said, there are three ways. They're called the allowance methods. One is based on the percentage of credit sales, the other is based on the percentage of accounts receivable, and the other is based on the percentage of aging of receivables, but we're not going to talk about that at all. So, what I did is I put up here some journal entries to kind of help illustrate the concept. The allowance method for the percentage of credit sales, which is also known as the income statement method, is very, very similar to the method, for the allowance method for the percentage of accounts receivable, which is known as the balance sheet method. But there is a slight difference towards the end that I'll talk about further. So, okay, let's say it's the 1st of January 2020. Someone walks in the door. They sign an IOU. I extend them store credit for $1,000. They sign a document saying, "Yeah, Mike, I'll pay you in 3 months the $1,000 at 2-3%, something like that." And out the door they go with my equipment. Okay, the revenue earnings process has been substantively complete. I'm an accrual-based accounting business. I can therefore recognize the revenue. So I debit account receivable, Mr. X, for $1,000, and I credit revenues for $1,000. Now, like I have pointed out before, I also have to recognize my costs. Okay, so I debit cost of goods sold for $750, and I credit merchandise inventory for $750. And remember, that's an adjusting entry. That's essentially a deferred expense. Now, December 31st of that year, 2020, rolls around. So the revenue transaction occurred on January 1st. It's now December 31st. And I have not heard from this guy. I have not seen this guy. Or maybe the guy is saying to me, I'll pay in a couple of months. I'm having some liquidity issues. I'll pay you soon. I'll pay you. I promise. So I've got a little misgivings here. It's like, I don't know if this guy's going to pay me or not. What do I do? If I'm going to do the direct write-off method, as I mentioned in preceding videos, I've got to do it now. But, because I have to match my expense to the time period in which that expense generated revenues. Okay, so I've got to do it now. But the guy still might pay me. If I recognize the bad debt expense, the account receivable comes off of this year's financial statements, comes off the balance sheet, and then I recognize a $1,000 bad debt expense that's going to lower this year's net income. Do I really want to do that? I don't know, So I opt to punt. Essentially, I'm going to adopt an allowance methodology. So what I do is I go through my books, and I do an analysis. Now, we're going to use the percentage of credit sales methodology first. We're going to do that first. Okay. So what I do is I look at my credit sales. Now, and remember, credit sales is a revenue account. It's a income statement account. It's a temporary account. It gets zeroed out at the end of the year. Okay. So I'm going to go through each year's credit sales and try and get an estimate of the percentage of bad debt of the people that welched on those credit sales in those years, okay, for those years. And so let's say I decide it's 10%. Based on my historical analysis, I estimate 10% of credit sales will go bad, okay? 10% of this year's 2020's credit sales will go bad. So what I'm going to do, and let's also say that in 2020 I had $1 million in credit sales, okay? So 10% of $1 million is $100,000. So on December 31st, I'm going to debit an account called bad debt expense, just like for the direct write-off. I'm going to debit bad debt expense for $100,000, and I'm going to credit this new account called allowance for doubtful accounts for $100,000. Now, the allowance for doubtful accounts, as I mentioned previously, it's a contra asset account. Think of it as an offset to accounts receivable in the same sense that accumulated depreciation is an offset to property, plant, and equipment. Okay, and so when you look on the balance sheet, what you'll see is accounts receivable less allowance for doubtful accounts, and then the net, and that gives you an idea of this is what we can actually really expect to receive in terms of payment from customers to whom we've extended store credit. Okay, now let's say another 6 months go by. So the revenue transaction is on January 1st, 2020. On December 31st of 2020, I made my bad debt expense, $100,000 credited, allowance for doubtful accounts for $100,000. And let's say another 6 months go by. So I'm now well into 2021, so I am way outside of the time period in which the revenue was recognized. And then I find out the guy has died. Okay, I'm never going to get that money back. I'm never going to get that $1,000 back from him. I missed the probate. The estate has been dissolved. I'm out of luck. Then I debit the allowance for doubtful accounts account for $1,000, and I credit the account receivable Mr. X for $1,000. So I zero out the account receivable by crediting it for $1,000. Now, what I've done essentially, it's right here, is your allowance for doubtful accounts. This is when on December 31st I credited it for $100,000. Like I said, it is a contra asset account, so it's going to be a normal credit balance account. And on June 30th, 2021, I debited the allowance for doubtful accounts for $1,000. So that's that entry there. That gives me a net of $99,000. That's $99,000 of, sort of think of it as a pool or a reservoir. I don't know who. On June 30th, I knew for a fact Mr. X is a deadbeat. I'm never going to get that money. So I debited $1,000 from the allowance for doubtful accounts. Okay. So think of the allowance for doubtful accounts is a big question mark. It's a big estimate. I don't know if they're actually going to go bad, and if they go bad, I don't know who. But as I identify them, as I identify the bad debt, I debit the allowance for doubtful account for that amount. Now, this is where things diverge between the percentage of credit sales methodology and the percentage of accounts receivable. In the percentage of credit sales methodology, which we've just gone through, I do this over and over and over again every year. Okay, so at the end of, assuming there are no further adjustments, at the end of 2021, so in December of 2021, I've got a balance of $99,000 in my allowance for doubtful accounts. And when I repeat that process again in 2022, I'm just going to do the same thing again. I'm going to take 10% of that year's credit sales. I'm going to debit, and let's say once again it's $1 million. So I'm going to debit bad debt expense for $100,000. I'm going to credit allowance for doubtful accounts for $100,000. So now I've got an ADA account with a balance of $199,000. And then let's say, the following June I determine Mr. Y is a deadbeat, and I debit Mr. Y's account. I credit Mr. Y's accounts receivable for $1,000, and I debit ADA for $1,000. So what I'm trying to get is, you can see is if I keep doing it this way, where at the end of every year, I just take 10% of the year's credit sales and credit the allowance for doubtful accounts. The allowance for doubtful account, so the allowance for doubtful accounts account just keeps getting bigger and bigger and bigger. So, and remember, the reason why we did this was, we started this whole thing was to bring some accuracy into the balance sheet. And remember, the allowance for doubtful accounts account is really kind of a question mark to begin with. So, we started out, maybe the first year we were fairly accurate, but as time goes on, that allowance for doubtful accounts account keeps getting bigger and bigger and bigger. And so the net effect, remember, when you look at the balance sheet, you deduct your allowance for doubtful accounts from your accounts receivable. And so what I'm getting at is, as the allowance for doubtful accounts keeps getting bigger and bigger and bigger, the net effect is that it eats more and more into your accounts receivable. And so you're introducing error, okay, uncertainty. So there's another way to do this. It's called the percentage of accounts receivable that helps kind of dampen down the error that we're introducing by just constantly adding to the allowance for doubtful accounts account. What really distinguishes, everything is essentially the same using the percentage of accounts receivable methodology as with the percentage of credit sales, except for the fact that when we make this entry at the end of the year, one, we're not looking at the year's credit sales, we're looking at the total accounts receivable, okay? Not that year's accounts receivable, the total of accounts receivable. And you're also keeping in mind the balance in the allowance for doubtful accounts. So let's back up. Okay, so we're now moving into 2022. All this still holds true, okay? I created the account with $100,000. I recognized in June of 21, I recognized that Mr. X is a deadbeat, so I deducted it. I debited the account for $1,000. That gives me a balance in the ADA account of $99,000. So let's say it's now December of 2022. And again, let's say I had $1 million in the account receivable account, okay? And I've estimated 10% is going to go bad. So I would debit bad debt expense for $100,000 and credit ADA for $100,000. However, because I'm using the percentage of accounts receivable methodology, I look at the balance in the ADA account. Well, I've already got $99,000 in there, but I should have $100,000 based on my calculation. So all I do is I debit bad debt expense for $1,000 and I credit ADA for $1,000. That gives me like $100,000. So, of all the methodologies, probably the best one to use, if you're not going to do a direct write-off in the period in which the revenues were earned, I think the percentage of accounts receivable methodology is the best way to go, because it tends to keeps the ADA account, the allowance for doubtful accounts account, kind of keeps that under control. Otherwise, if you're using the percentage of credit sales methodology, that account just keeps getting bigger and bigger, and I mean massively bigger and bigger and bigger. And so you have this exponential error factor that's building up on your balance sheet if you use that methodology. So, hope this makes sense.